Palantir has dropped over 50% in the past couple of months, not based on any negative catalysts for the company or its growth prospects, but more so because of macroeconomic trends and rising inflation. But in my opinion, Palantir is actually hugely oversold right now because inflation isn't actually that bad for the company, and certainly not as bad as it is for other growth-focused tech stocks. Let me explain. Quick disclaimer here, I'm a Palantir bull and I currently have 968 shares at an average cost basis of $21.06, so I'm getting pretty close to my 1,000 share goal. And as you can see from my investment tracker spreadsheet here, I've actually changed the color in my gain loss column from red to a nice calming blue, so that whenever I look at this, I don't have to see a sea of red. It's all about psychology. Anyways, in this video, I'm going to break down 3 of the reasons why growth companies are normally negatively affected by inflation, and I'm going to tell you why Palantir is more or less unaffected by every single metric. So inflation means that the cost of goods and labor worldwide is increasing, and it's having a disruptive effect on global supply chains. Roku is a great example of a growth company that's been hit pretty hard by this because their hardware side of the business has seen its profit margins squeezed to the point where they've actually gone negative. And the only way that they're actually managing to stay afloat is because on the subscription side of the business, they have a much higher profit margin. Now, the aspect of inflation that's tied to the tightening of profit margins is definitely more so linked to physical products as opposed to software solutions. And that's why in this regard, Palantir will remain relatively unaffected. Of course, they may see some increases in the cost of labor or their fixed costs, for example, the overhead of having offices worldwide and paying for electricity and office supplies and things like that. But Palantir has very healthy gross profit margins of nearly 80% because they're a software company, so they should have no problem rolling with the punches. Also, the number of large sticky contracts, meaning clients that keep re-signing over and over and over again because either the product is so good or the cost to switch are too high, is going to keep Palantir from being affected by inflation in the same way that some other growth stocks will be. Palantir is generating solid cash flow from operations, and they have over $3 billion in outstanding deal value, meaning revenue that they've booked for the future but that hasn't actually come in yet because the contracts are for the next couple of quarters or the next couple of years. They've also got massive government contracts and have signed deals with pretty much every US security institution or agency that you can think of, including the Army, the Navy, the Air Force, the Special Forces, the Space Force, the CIA, etc., etc. And as somebody that used to work for the Defense Department in Canada, I can confirm that it's very hard to become an approved supplier in these kind of high-stakes security environments. There's usually only a tiny handful of companies that are even qualified to bid on some of these major government contracts, and in the case of Palantir, with its data analytics and AI software, they don't really have competition at all for a lot of the type of deals that they're inking. Also, the wheels of bureaucracy grind very, very slowly, so once you're in and you've proved your value, which they've been doing for the past couple of decades, it's not like things are going to change anytime soon. And one final point to round out this part on the tightening profit margins is that this might actually be an opportunity for Palantir. The fact that there's global supply chain disruptions is exactly the sort of thing that Palantir Foundry was designed to help address. One of Foundry's best use cases is to analyze supply chain data and to help companies optimize for speed, efficiency, and cost savings. So not only does this aspect of inflation not really affect Palantir as a business, it may even prove to be an opportunity moving forward. Okay, a second major way that inflation usually affects growth companies is because it increases the cost of debt. As inflation rates rise, then central banks around the world have to increase the interest rates to help try and tamp that down, which raises the cost to borrow money and then to finance your operations with that debt. But in the case of Palantir, this is actually not relevant at all because they have zero long-term debt and they have a 4-to-1 current ratio. What that means is they have over $4 in current assets for every $1 in current liabilities, meaning they can easily pay off any short-term debts that they have and still have plenty of wiggle room. And in fact, if we compare Palantir's debt to the software industry average, it's actually laughable because Palantir's debt is at 0%, whereas the industry average is 35.7%. So yes, there's a lot of companies that should be afraid of inflation precisely because of the rising cost of the debt that they're holding on their books, but Palantir is not one of those companies. Okay, finally, let's talk about the time value of money. Now, I'm not gonna pretend like this doesn't affect Palantir, but I think it's blown out of proportion in certain regards. So in simple terms, company valuation models that try to figure out what a company like Palantir will be worth at some point down the road account for the fact that money today is worth more than money in the future. And the reason for that is just opportunity cost. If you invest in a company like Palantir today, you're investing in the hopes that it's going to grow at some point in the future, whereas your opportunity cost by making that investment in a company like Palantir is the rate of interest that you could earn on that cash right now. And bond yields are used as a proxy for that opportunity cost. So as inflation rises and the Fed or other central banks around the world have to raise the interest rates to try and tamp down inflation, the bond yields also rise, which changes the valuation models. And that's what's going on right now. So in anticipation of the Fed increasing interest rates, bond yields have started to rise, which means that the present value of money has increased. That said, the question that analysts and investors have to ask themselves now is whether or not interest rates going up a couple of points is enough to change your calculations that you would want to move your money out of Palantir and put it into something else. In my opinion, the answer is an easy no, because I believe Palantir has significantly higher upside potential over the next 5 to 10 years. A few extra points on bond yields today compared to 30 to 40% revenue growth year over year, a growing TAM that's only going to continue to grow as they launch new products, solid cash flows, zero debt. In my opinion, it's not really a competition. And when you couple that with the fact that the other negative impacts of inflation aren't really relevant to Palantir, I just don't think that the impacts of inflation are going to be nearly as bad for Palantir as they are for other growth-focused tech stocks. And that's why I think Palantir is just ridiculously oversold. I'm not selling any shares. I haven't sold a single share since I started investing, and I'm going to continue just dollar cost averaging as I get in at lower prices. I'm bringing my cost basis down, and you know what? For someone with a long-term time horizon on this investment like me, that's great.